สวัสดีค่ะขอต้อนรับเข้าสู่การนำเสนอข้อมูลของบริษัท PSL Shipping จำกัดมหาชนนะคะสำหรับไตรมาส 2 ปี 2020 นี้โดยการนำเสนอข้อมูลโดยคุณคาลิด ฮาชิมกรรมการผู้จัดการในเรื่องของภาพรวมของอุตสาหกรรมและจะตามโดยในเรื่องของตัวเลขทางการเงินโดยคุณก่อตั้งบูรณากรรมการทางด้านการเงินนะคะและในช่วงสุดท้ายในเรื่องของคำถามคำตอบค่ะเชิญช่วงแรกนะคะของคุณคาลิด ฮาชิม
สวัสดีครับ We will do the presentation in two halves as usual. On the first half, we will have the industry presentation, which I will do, followed by Gautam, who will take care of the financials of the company. So the first slide that we have put up for you shows you how the BDI has been reacting, and you can see a clear trend line. The trend line, of course, was broken during the period of COVID, but after that it has reacted very nicely, and as you can see, it is starting to come back up. If you look at the first half of the year 2016, compare that with the first half of 2019 and 20, you can see that despite COVID coming in, 2020 has not been as bad as 2016, and right now presently is faring better than 2019. This gives you an idea as to how the expected cargoes or cargo flow will take place, and you can see that more or less 2020 should be equal to or slightly better than 2019. If you look at what's happening on the supply side, you can see clearly that in the first half of 2019, less than 5 million deadweight tons of ships were scrapped, but in the first half of 2020, almost 8 million tons of ships were scrapped. Please keep in mind that we lost almost 3 months of scrapping because of the lockdown starting in the middle of March and ending at the first week of June in India, Pakistan and Bangladesh, which are the major scrapping centers of the world. Clarksons predicts that the net fleet growth will be between 2 and 3%, whilst our predictions based on very conservative calculations is at 4.43%. If you look at China's growth and ask the question, is it sustainable? Then if we look at the numbers from the first half, you can see that iron ore has gone up by 9.6%, coal has gone up by 13.3%, steel production has gone up by 2.4%, and if you look at steel imports, even though China produces more than half the entire steel in the world, it is still up at 26.1%. Steel consumption in China is also up by 3.9%. If you think that China does not play a significant role, then these numbers will change your mind. If you look at the first 7 months results of China's imports, you can see that they've done really well, and you can see that other than nickel ore, which has come down by 33% because of a ban on exports in Indonesia, other than that, every other number is significantly up. This shows you the growth in seaborne dry bulk trade in billion ton miles, and the expectation was for a 4.1% contraction. Please keep in mind this data is based on Clarksons database as of the 1st of July, and it does not take into account the new way in which the market has reacted post the first half of the year. We suspect that once Clarksons revises these numbers, we will see the percentage change in trade narrowing and coming up closer and closer to 2019. This gives you minor bulk trades, and the same explanation applies. If you look at PSL's cargo exposures, you can see what we're exposed to. Please keep in mind that the cement exposure is mainly on account of the 4 dedicated cement carriers that are employed on the Indian coast. If you look at the overall change in fleet supply as of the end of the first half of this year, you can see that the total deadweight tons increased by 21 million deadweight tons, or about 2.37%. If you look at the balance order still to come, there's another 67.4 million deadweight tons up to the end of 2023, or roughly 7.5% of the overall existing supply as of the end of the first half of this year. If you break that down, you'll see that the geared sector has a 5.3% supply increase expected over the 2023 period, whilst the gearless ships or the bigger ships, where we are not represented, has an 8.8% increase in supply expected. So if you look at the dry bulk supply side, we began the year at 873.43 million deadweight tons. In the first half of this year, the expected deliveries were supposed to be 36.23%. Actual deliveries were 28.79%, so there was a slippage of 20%. And we had 8.06 million deadweight tons of scrapping, and we ended the first half at 894.16 million deadweight tons. If you use the same results of the first half and project it into the second half, then you would see that you get a fleet growth of 4.43%, whilst Clarksons predicts somewhere between 2 and 3% growth. If you look at the order book figures and look at it historically, then you would see that the order book today is at one of the lowest levels that has been there since the turn of the century. If you look at the overall order book, it's at 7.5%. If you look at the old age ships or ships over 20 years of age, the current age profile is at 6.65%. And if you extrapolate that age profile to the end of 2023, because the order book is up to the end of 2023, then the overall 20-year-old ships will be 11.7%. So it appears that the order book is equal to or less than replacement. If you analyze the same thing for the handy-size sector, you can see that the total fleet as of the end of the shows it at 108 million deadweight tons, with a total order book of 4.32 million, or roughly under 4%, with an existing 20-year age profile of 13.4% and an extrapolated age profile of 20-year-olds at 17.2%. So it appears that the handy-size fleet is going to shrink. If you look at the same analysis for the Supra and Ultramax fleet, you can see that the total fleet strength was 210 million deadweight tons. The order book was at 11.35 million deadweight tons, or roughly 5.41% of the existing supply. And the existing 20-year-old ships were at 8.57% and extrapolated up to 2023, that is that 13.67%. So it appears that both these sectors will have an overall shrinkage in the fleet by the end of 2023. If you look at what's happening in terms of scrubber intake and look at our operating segment, then you'll see that only 8% of the ships have opted for scrubbers and 92% have opted for burning lower sulfur fuel oil, just like pressure shipping has done. What is the impact of IMO 2020 on the geared sector? So to understand this, we need to understand the age profile of the fleet. And if you look at the age profile of the fleet and look at the price of oil during that age, when those ships were built, you would see that 20 years or more ago, the oil prices averaged just under $20 a barrel. And therefore, ships were designed with high engine capacities and high fuel consumptions, more for power and speed than for fuel economy. However, ships designed and built after 2011 were designed and built for eco-consumption. So you can see on the numbers that we have put up for you that you just need a half knot slowing down in speed to make a 4.2% reduction in the supply side. And we are seeing that type of a slowdown in the overall dry bulk fleet today. So what are the key takeaways that are there from the slide that I've shown you? First of all is that the market is recovering. The second one is that China has been able to successfully reopen its economy post-COVID-19, but the negative impact of the world's economic activity started out in the end of March and has come to a close at the end of May. After that, the entire world, including China, has turned reasonably positive. China has also instituted a 667 billion stimulus plan, which is 15.8% higher than what they did after the global financial crisis in 2008. And you know what happened in 2008. The market had sunk to 666 points on the BDI on the 5th of December in 2008. And because of the stimulus plan of $567 billion that China put up, the next year the market went up to 4,661 points. Now, Q2 has proved to be more challenging, as roughly 55% of dry bulk trade is with the rest of the world was impacted because of the virus countermeasures. Global capital markets still remain frozen, and that is something which will, in a way, is good because it will stop ordering of new ships, but it's bad in the sense that to raise funds becomes more difficult. Vaccine developments around the world are encouraging. However, the latest news with the AstraZeneca trial being stopped because of one illness is alarming. Governments and central banks around the world have responded to the pandemic in a very robust manner. The problem is the time lag between the time when governments enact such robust fiscal and monetary stimulus and the time when it improves dry bulk demand. And we expect that to happen in late Q3, early Q4, and going all the way through to 2021 and maybe even 2022. So until then, the market may remain under some pressure. So coming to COVID-19 and its impact. So right now, as of the 8th of September, 215 of the 237 countries in the world have reported COVID-19 cases, and roughly 90 countries remain in some form of full or partial lockdown or travel restriction. Totally, 27.2 million people have been infected by the virus, and almost 891,000 people have died from the virus. 18.1 million people have recovered. What is the impact on shipping? Coming to cruise lines and car carriers, you can see that the monthly cash burn for the two largest players in the cruise levels, RCC with a USD $250 million burn per month, and Carnival Cruise Lines with a US $1 billion cash burn per month. Carnival reported the single largest quarterly loss in shipping's history for Q1 at $4.4 billion. Norwegian Cruise Lines reported a $1.9 billion loss for Q1. As of the first half of 2020, there have been multiple bankruptcies in the cruise space. Coming to car carriers, Wallenius Wilhelmsen, which is one of the largest car carriers in the world, they reported a $285 million loss in Q1. So you can see clearly that there has been a big impact on cruise lines and car carriers. Coming to container ships. Container business in the world is highly concentrated. The top 10 container lines have between them more than 85% of total capacity. So what did they do? In the face of the COVID-19 situation, they started reducing supply. And you can see clearly from this graph that roughly 10.10% of supply has been idle. As a result, in the first half of this year, profits have gone up by 160% compared to last year. And according to Sea Intelligence, this is an analyst in the container line business, they expect a profit of somewhere between $12 and $15 billion for the container sector as a whole. Even if volumes decline by 5% during the second half of this year, they still think that the profits will be very reasonable for container lines, all because of their ability to reduce capacity. Coming to dry bulk. Dry bulk has shown a smaller loss than car carriers and cruise lines, but it has not shown the type of profit that was there in the container sector because dry bulk is extremely fragmented. China has led a strong recovery in vessel earnings in the second half, starting in the second half of this year. A steel-intensive stimulus of $667 billion should help the market recover quickly. Seasonal forces should also assist the market in the third and fourth quarter of this year. And we've already touched upon this. Lockdowns in the Indian subcontinent had reduced one full quarter from the recycling market. if you look at the response by the various governments, you can see that the fiscal response alone was equivalent to $14 trillion. And if you look at the central banks that have cut 167, that have made 167 rate cuts all around the world and have pumped $8.4 trillion of monetary support into the global economy, then you realize that the total stimulus, both fiscal and monetary, is approximately 23% of world GDP. With that type of robust fiscal and monetary policy to support businesses, we expect that the recovery should be sharp and quick in 2021. Again, this is news on vaccines, tests and cures. This is quite important. In terms of oil prices collapsed during the first quarter of this year, and the reason for that was because of the over-pumping of oil by Saudi Arabia and Russia, at the same time colliding with the destruction of demand by the COVID-19 situation. So what is our strategy? Our strategy is to try and fix our ships on long-term contracts the minute the markets recover. We had hoped we could have done that this year, but that has been delayed because of COVID-19. We hope to execute this strategy either towards the end of this year or sometime early next year. In terms of our fleet, we've got 36 ships. The average age as of the middle of this year is 8.8 years. The insured value is $650 million, the book value is $648 million, and total deadweight is 1.6 million deadweight tons. And the average size per ship is 44,000 deadweight tons. If you look at our forward book, it shows you how much of revenue is already pre-booked as of today. And you can see that quite clearly, that we have got something like between 14 and 17% of all of our entire fleet days available that have already been pre-booked. Now we come to market segmentation. Now if you look at market segmentation and look at how we have fared in Q2, you can see that on the handy-size index, we have outperformed the index by 16%, even though our ships are much smaller than the index ship and they consume more oil than the index ship. If you come to the Supramax sector, you can see that we've underperformed the index by 34%. At the same time, don't forget that we have a smaller fleet deadweight tons than the index ship, and that our ships consume more oil than the index ships. If you look at our Ultramax fleet, unfortunately there's no index ship to compare it with, so we have compared it with the Supramax. There we have outperformed the index by 65%. With that, we come to the end of the industry section, and Gautam will take you through the financials.
Thank you for the help. So on the 19th of May and the 30th of July 2020, we held two bondholder meetings for our two bonds, PSL 206A and PSL 211A. We successfully amended the terms of the bonds, whereby the maturity date has been extended by 18 months for both the bonds. There's an increase in coupon of 150 basis points during the extended period. Both sets of bondholders would receive a 20% upfront payment on the initial maturity date. And also we have the right now to buy back or to redeem any part of the bond during the extension period in any amount. So these amendments have allowed us to extend our cash runway, a step which makes us more resilient and also better equipped to weather the impact of COVID-19. We had a long-standing arbitration with St. Shipyard, where we had a number of ships where we had ordered a number of ships, and then we had subsequently cancelled those orders. We have now come to an amicable end of that arbitration. This has resulted in PSL receiving a net cash payment of $40.5 million. We received this on 29th of July. We had on our balance sheet a $67.9 million amount, which was shown as advance to shipbuilders. Now that advance to shipbuilders has been removed and it's been replaced by $40.5 million in the cash portion of our balance sheet. We also took a non-cash loss of $27.4 million in our second quarter 2020 P&L account. This non-cash loss reduces our equity by $27.4 million. The important thing is that we got the much needed cash today during this time of COVID. It also saves us additional legal costs of about $3 to $5 million per year. This is an overview of our operating expenses. Operating expenses have been quite stable. Crew costs have remained stable. However, overall costs have actually come down and are in fact lower than the budget that we set ourselves for the year in 2020. This is mainly driven by lower manning expenses and also lower stores and spares expenses. This is a comparison of our operating expenses against the industry average. You will see that as far as crew costs are concerned, our costs are quite similar to the industry average. However, on all the other costs factors, we are more competitive, more efficient than the industry average. We are about $700 per day per ship, lower than the industry average. Each $100 of saving in operating costs translates to a $1 million difference in the bottom line. So therefore, if there's a $700 difference, it translates to about a $7 million additional profit for us relative to our competitors or the industry average. This is an overview of our financial profile. In the first half of 2020, so 30th of June, our cash position was 29 million, down from 39.2 million at the end of 2019. Total asset figure was 759 million, down from 831 million. This was down because of depreciation, a lower cash amount. There's also an impact of the TFRS 9 regulation. Our gross debt was 385 million, quite similar to the figure of 391 million in the end of 2019. Net debt 356 million, slightly above the 2019 figure of 352 million. The equity figure was down to 336 million from 383 million due to the loss, the $41 million loss in the first half of this year, and also due to the impact of TFRS 9. Our gross debt to equity ratio was 1.15, slightly up from 1.02, mainly because of a lower equity amount. EBITDA for the first half, due to COVID, earnings were very low, so EBITDA came in at 11.3 million, down from 44.5 million for the full year 2019 and 68 million in the full year 2018. Debt to EBITDA came in at 9.2%, 9.2 versus 8.3 in 2019. So daily earnings came in at 7,249 for the first half of the year, down from 9,622 in 2019 and 11,063 in 2018. The impact in the first half was mainly felt due to COVID. Daily operating expenses came in at 4,566, below the figure last year of 4,778, and even below the figure in 2018, which is 4,621. We incurred a net loss of 41 million in the first half of the year, mainly, as I said, due to the settlement agreement that we signed with Senti Shipyard. This is greater than the loss of 7.2 million in 2019. These are the financial highlights broken down by half as well as by quarter. So in the second quarter of this year, our total revenues came in at 20.86 million, down from 34.08 million in the first quarter. So the second quarter is when we really felt the brunt of the COVID impact, the shutdowns around the world. Gross profit as a result was down to 7.17 million, down from 14.22 million in the first quarter. The net loss for the quarter came in at 37.32 million, up from a loss of 3.68 million in the first quarter. The loss, only due to the Senti arbitration, was 27.4 million. The loss after excluding non-recurring items, so it was for the second quarter was 9.7 million, so up from the 4.46 loss in the first quarter. EBITDA for the second quarter was 2.63 million, down from 8.71 million recorded in the first quarter. The average TC income per ship per day came in at 6099 per day, down significantly from the 8398 figure recorded in the first quarter. Average ship running cost per ship per day came in at 4531, slightly below the first quarter figure of 4602. Our earnings or loss per share in bahts came in at 0.76 compared to 0.08 in the first quarter. After excluding non-recurring items, that loss was 0.2 compared to 0.09. This is a picture of the financial highlights of our financial position. So our liquidity, which includes undrawn commitments, stood at 39.06 million as of the end of the second quarter, down from 67 million at the end of last year. The total current asset position, 56.27, quite similar to the 55.73 figure at the end of last year. Advances to Sainty, so over here, as we said, we took a reduction, we took a loss, so that is down to 40.5 million from 64.12 million. Total current liabilities stood at 11.17 million, down from 20.81 million at the end of last year. Total long-term loans stood at 234.75 million, down from 237.09 million at the end of last year. Total debenture exposure, over here it shows 165.97. However, after taking into account the currency hedges that we have, the exposure is about 150 million. Slightly down from the previous figure because we have made some initial redemption payments to our June PSL 206 bondholders. Total liabilities stood at 423.2 million, down from 447.76 million at the end of last year. The book value per share in Thai baht stood at 6.66, down from 7.41 as we took a loss in the second quarter. The number of ships that we had that remained constant, we had 36 ships. This graph shows the evolution of time charter rates and operating expenses for our fleet over time. The top row, it shows the average age of our fleet. So you will see that from 1995 to about 2011, the average age of our fleet was about 15. Thereafter, we embarked on a new building program. We ordered a number of ships. Those ships got delivered thereafter, and therefore you see the average age of the fleet reducing over time. It came to its lowest level in 2016 when it was 5.8, and then ever since then it has been gradually moving up. The red line under that shows the average deadweight of our fleet. You will see that initially the average deadweight of our fleet back in 1995 was about 19,000. It remained fairly stable until we embarked on a new building program. So in 2010 thereabouts it was 24,000 deadweight, and then you see quite a sharp increase over that initial few years period. It is currently about 44,000 deadweight. So we acquired the Supramaxes and the Ultramaxes in our fleet, so the average deadweight size went up. The time charter, the line below that shows you the average time charter rate for our fleet. So in 1995, the market was quite strong. The rates were 7,300. Then we had the Asian financial crisis. Rates went down. We saw average rate of 4,000. And then you saw a gradual increase in rates. In 2005, the average rates, the earnings for our fleet per day were 14,449. And then again in 2008, it reached 16,489. Thereafter, there was quite a large order book that got delivered. And so there was a substantial supply overhang which impacted rates. So there was a gradual reduction in rates, and then you saw rates sort of bottom out in 2015-16 when they came to about 6,266 in 2015. Since then, the order book has been very manageable, and therefore we have started to see an increase. In 2018, we saw good rates, 11,000. 2019, rates were impacted in the first half due to an accident in Brazil at the Vale mine. 2020 has been impacted, of course, by COVID. The line below that shows our operating expenses. operating expenses have remained fairly stable. They sort of peaked in 2009 at 5040 when the average age of our fleet was quite old. Ever since then, we have taken delivery of new ships. Our operating expenses have gone down, but the ships are also larger, so therefore their operating expenses are more on average than the ships that we owned back in the sort of late 90s and early 2000s. This graph shows the evolution of our debt to equity ratio over time. The ratio, as you can see, it sort of peaked in 1997, came down to zero. We paid down our debt completely in 2006 and 7, and then gradually, as we acquired new ships, we took on more debt. That peaked again in 2016 at 1.3, and then since after that, thereafter, it has been coming down. Our plan is to bring it down further to a level of, let's say, 0.8, 0.9. This graph shows the debt to EBITDA ratio over time. Debt to EBITDA is very much a function of the average age of the fleet. So the ratio skews to a higher level when your fleet is young and skews to a lower level when your fleet is old, and that's what you're seeing over here as well. So we had largely older ships from 1995 to 2010, that the ratio was quite low. Then we took delivery of newer ships, we took on more debt, and so that our debt to EBITDA ratio also was at a higher level. But of course, since we have been paying down the debt on those new ships that we've taken delivery of, that debt to EBITDA ratio has been declining. This graph shows the cash operating profit and the operating profit up to June 2020. You will see that, notwithstanding the fact that our operating P&L has at times been negative, the cash operating profit has very few times in our history been negative. The only times it was negative was 2015 and 16. Even most recently, in the first half of the year, it was a slightly positive figure. Do also note, it was quite stable 1995 to 2003. Then we had very strong markets in the dry bulk industry, so it went above $100 million for several years. And then, as I said, you had a supply overhang, many ships started to decline, and now we're starting to see what we think will be a gradual increase, because again, the supply factors are much less of a concern today. This graph shows the evolution of net profit and cash profit over time. So again, it's fairly stable from during the 90s, early 2000s, very strong markets in 2003 to 2009, and then gradual decrease. It came to the lowest level in 2015 and 16, and then an increase thereafter, a gradual increase is what we anticipate. This graph shows the dividends that we have given over time. So our dividend policy is to grant not less than 25% of net profit. We haven't given dividends since around 2014 because the market's been under a tremendous amount of pressure. It is definitely our intention to start giving dividends once the markets are more stable. This graph shows the total return to shareholders from the time of IPO in 1993 to 2020. An investor who bought our stock back at IPO in 1993 would have made a 9x return, or a 16% annualized return. This graph shows the value of an investment to shareholders if they had bought the stock, our stock, at various points of time. So if they had bought the stock in 1993, it would their value, the value of that investment as of 30th of June would have been about 10 times. If they had bought it in, for instance, in the year 2000, that the value of their investment would have been 41, almost 42 times. If they had bought a stock in 2020, at the beginning of 2020, there would be a slight decrease, again because of the impact of COVID. Thank you.
So we can take the questions that have come in on the net. So beginning with the first question, asking about the second half of 2020 and whether the loss would reduce or not, and whether we would turn profitable or not, and how long it would take. The short answer is that we do not give forward-looking statements, so therefore I really can't answer that question. Looking at quarter 3 2020, have we passed the lowest point of the cycle? And what is the operating outlook for the company year on year, quarter on quarter? So this you can see by the charts that we already put up for you. It looks quite clear that the low point of the business has passed in quarter 2, and now we are at the higher point, starting at the higher points of the year. And what is the next question? What is the outlook of BDI in the second half of 2020? So here I would say that if we look at the first half and look at what's happened in the second half in 2019, then I would expect a similar type of boost in the second half from a seasonal factors, as well as the fact that in the first half we had a destruction of demand due to the COVID-19, and that demand is starting to come back in the second half. So we should have a really much better second half than the first half. Then what is the operating outlook in the second half? I think we've already answered that. When will the company turn profitable? As I said, we don't give forward-looking statements on our financials, so I'm afraid we can't answer that question. The next question is about a comparison of our ships with the performance in the market ships, and we've shown you that under the segmentation slide. The next question is, now that the legal dispute is over, do we expect SG&A going forward to be around at a lower level? Yes, we will definitely see a much lower level of SG&A, because as we said that we were spending somewhere between $3 and $5 million per annum on our legal costs just on the Senti exposure. Coming to the next question, potential expected improvement in rates for Q4 20 and 2021. Again, we don't give forward-looking statements, but as you can see from the presentation, the fiscal and monetary stimulus provided by the various governments around the world should push the market in the right direction, in the upward direction. The next question, typically there's a seasonality with quarter 4 and quarter 1 starting to come down, but in the current environment, will this change? We expect a change. We expect that Q4 will be the strongest quarter this year, and from there onwards, the market will start to behave in a more normal manner. So far, how many dry bulk companies have gone bankrupt? How many businesses have closed down? And are these numbers increase? Will these numbers increase next 1 year? We don't have this data. As I said, dry bulk is extremely fragmented. Most of it, majority of it, is only in private hands. Therefore, we are not able to access those numbers. But we can say clearly that the stress in the market is extremely high. After that, I think there are some questions that Gautam will answer.
Right. So the question is, cash flow of the company is still positive every quarter. Now, if you look at the indexes, the Baltic Supramax Index and the Baltic Handysize Index, their both average rates are above $10,000 per day, which is a very healthy rate. So on that basis, yes, the cash flow of the company would certainly be expect to be positive. Does the company already taken care of all debentures issue? How the company deal with all debentures issues? So the debentures the terms have been amended, and the company has made payments. Initial payments. The company will be making further payments to pay down the debentures over the next few months. So certainly it will be taken care of. For the cash advance shortfall with Senti Shipyard, was there any bank guarantee or guarantor we could claim the shortfall with? Yes, there was a guarantee, definitely, but we could not claim under the guarantee if it was disputed, if the terms of the cancellation were disputed, and that's why it goes into arbitration. So why or why not was the arrangement not in place? So yes, for some ships, actually there was no dispute. The shipyard did not dispute the cancellation, so the payments were made immediately. However, for 9 hulls, they disputed the cancellation, and so therefore it went into arbitration. But I think the result that we have is still quite a positive one. We've got the cash today, 40.5 million, so that's a good thing. With our credit rating, do we see any issue with borrowing from banks or issuing debentures? How can we improve our credit rating? So our credit rating has actually received a slight uplift last month. It's not really a full rating upgrade, but it's a slight uplift. We expect that with the rate environment improving, with the economy stabilizing, there should be further rating upgrades. So yeah, how can we improve our credit rating? It is very much a function of markets. We have taken steps as management to boost our liquidity. So we have entered into the settlement agreement. We're taking other steps as well, which will be announced soon, to boost our liquidity, and that will, we believe, will help in increasing the rating.
Coming to the balance questions, what measures have we implemented to reduce cost amid COVID-19? You can see that quite clearly. Daily operating cost has already come down, and we hope that we will be able to maintain it at this type of level. Have we seen many dry bulk operators go out of business over the last? I think I already answered that question. What percentage of our fleet do we target to fix on long-term charters by the year end? We have no fixed targets. The target is that if we can get a good long-term contract at a price that is acceptable to us, then we will fix not one but all the ships on long-term charters. So I think with that we have come to, or we have one more question. Yeah. So PSL is not responsible for fuel costs for time charters. Would it be inaccurate to say it indirectly affects PSL because the customers bear the burden, hence it affects the budget of the customer there? Yes, the time charter rate that we get from the customer is dependent on the amount of fuel that we burn in our ships. Obviously, the more oil that you burn, the less the customer will pay you. And that is also shown to you in the market segmentation slide. Then on 16, and the next question is, the reason the Ultramax in Q2 was lower than BSI, but Supramax higher than BSI. Okay. Ultras were higher than the Supramax index and the Supras were lower than the Supramax index. The reason for that is quite simple. If you look at the speed consumption of the ships, the size of the ships, then our Supras are definitely inferior to the index ship. Remember, this index ship is a new index ship that has just been incorporated for the last 1 year.
70.
Yeah.
70.
Do you see any evidence that the market will improve in late Q3 to Q4 this year? I think it's quite obvious from just looking at the slide that is there right now in front of you. You can see by the end of Q2, that is during the month of June, you can see how sharply the market has gone up. How does the company affect, what is the effect on the trade war? Not much of effect from the trade war. In fact, if you look at China, they are buying so much more grain than they have done last year. So China is doing a marvelous job in terms of buying iron ore, buying coal, buying grain, producing steel, importing steel. So China has really done well from a point of view of the business. So whichever number you look at, and you just put it up for Jan to July, actually the Jan to August numbers have also started to come in, and they're looking even better than these numbers. Then how much speed can ship owners realistically reduce, and what is the implication of the supply taken out of the market? I've already put this down in terms of a calculation under the on the slides. Just bring this up for you. So here, if you look at this slide, you can see clearly that if you were to go and look at the potential impact of only a half knot slowing down, you would see, and just for 200 sailing days, you'd see that the fleet would reduce by 4.2%. So that's the type of calculation that is there. Okay, the next question is about the growth plans for the company. Right now, we have no growth plans at this moment because we have a debt level that we feel uncomfortable with and which we want to pay down. Once that has been done, then depending on the cycle of the market, when the market cycle is really, really low, that's when we will try to buy some more ships. Yeah. What measures you plan, given that the EBITDA was only 11 million in the first half, which was matched by using 10 million in outflow on interest payments? This is clearly a dangerous situation. Yes, certainly it's a dangerous situation, but we've already countered that. First of all, with the market helping us in the month of June, with the rates going up, and thereafter we've also been able to push back all our debts that were coming up due, plus raising cash through the settlement with Sainty. We did not complete the arbitration for the same reason, because we were not 100% certain of winning, yet we went ahead and got a settlement from them at a very reasonable amount and got the cash into the company, and that's what is helping us. Okay, where are our ships located? Right now, the majority of our ships are located in the Pacific Ocean. If you divide the world into two halves, Atlantic and Pacific, then we are right now in the Pacific Ocean and the balance is in the Atlantic. So more than 50% is in Pacific. I think with that, we have come to the end of the Q&A and thank you so much. Sawasdee ka.